How would you feel if I told you you can make money without having to lift a finger? How would you feel if I told you you can make money in your sleep? There's actually an easy way to do that, and that's with dividend investing. Hey guys, what's going on? Welcome back to the channel. Today we're going to be discussing all things dividends, how to get started with dividend investing, what dividends are, how much money you can make, and stick around till the end and I'll give you some of my dividend plays. Well, if you're already invested into the stock market, you've probably seen random money pop into your account. Check your account one day and you have a balance of $3.50. Or that you get a notification that your one stock has just paid you out $10 for doing absolutely nothing. And this is what dividend investing is. Well, dividends are a portion of the company's profits that they pay out to you, the shareholder, for investing in their company. But why would these companies give out free money randomly? Well, you have to remember, when you invest into that company, they're using your money that you invest to grow the company. You're a part owner of that company, even though it might be 0.0000000
6.5 hours later.
001, you still own some of that company. So by default, you should be subject to some of their profits. And that's exactly what dividends are, some of the profits from the company that they pay back to you. Well, not all companies pay back these profits. Most of them are usually well-established companies that have been around for a while and are outside their growing phase. A lot of the companies that are paying dividends are well-established companies like Coca-Cola, consumer products, like Johnson & Johnson, and so on. You're not going to be seeing a lot of growing companies like AMD and Nvidia paying back dividends because they would rather put that money into research and development and grow the company faster rather than paying back the investors. So rather than getting money back through cash flow and dividends, you're going to be getting money back from appreciation of the stock. These are usually paid out in two different ways. Either monthly, so you get paid a dividend every single month like another paycheck, or quarterly, which is every 3 months. The amount you get paid is dependent on two things. The first one being how much you have invested into the company, and the second thing is a dividend yield. You know I have to take a break here. I have to pause you guys in the middle of this video because the majority of you guys aren't subscribed to my page. So take a second, hit that subscribe button, and we'll continue on with the video. No, seriously, do it. What's a dividend yield? Well, I'm glad you asked. A dividend yield is a number that represents the percent you're getting back on your investments. So if a company has a 2% dividend yield, you're going to be getting paid 2% of what you have invested. So like I said, company A has a dividend yield of 2% and you have $1,000 invested into that company. That means you'll be getting $20 every single year. This could be $5 every quarter or every 3 months, which is 4 times a year, or it could be split up monthly, which is I think $1.30 or something like that. But no matter how it's split up, you're going to be getting that 2% every single year. Now, the two most important dates you need to pay attention to when investing in dividends is the first one, which is ex-dividend date, and the second one, which is a dividend payout date. Well, the ex-dividend date is the date you need to have your money invested in that company in order to receive a payout. So if the ex-dividend date is January 30th, you need to have your money invested by January 30th to get the payout. And then the payout date is exactly what it sounds like. That's the day you get your money back. So usually these are about a couple of weeks or a month apart. So if company A, let's say Apple, has a 2% dividend yield on their stock, and their ex-dividend date is January 30th, and you have $1,000 invested into Apple on January 30th, that means by the dividend payout date, which let's say is February 15th, then you're going to receive $20 on that investment. In order to receive the dividend, you need to have money invested into that company by the ex-dividend date. So if the ex-dividend date is January 30th, and you sell your stock on January 20th, you're not going to get paid out that dividend. Or if you buy stock after the ex-dividend date, you won't get paid out even though that payout date hasn't happened yet. You have to be invested in that company on the ex-dividend date. So let's put this in simple terms. Imagine you have a cookie jar and you love to share your cookies with your friends. In order for your friends to get the cookies, they need to be over your house by a certain date. And if they're not, they get no cookies. Some of you may be thinking, why can't I put $10,000 into Coca-Cola the day before its ex-dividend date and then just sell the day after? Well, technically you can. You'll still get your dividends that you had that $10,000 invested for, but dividend stocks usually drop by their dividend yield every quarter, every month in order to prevent things like this. So if a stock has a payout of 50 cents and it's $10, it's going to drop to $9.50 at its ex-dividend date. So this avoids people from buying the day before and selling the day after. So a lot of investors usually use dividends to completely replace their income or supplement that to take over some payments. So if you are one of those people that want to use dividends in order to replace the total income and retire, let's take a look at how much you actually need. So the first step is figuring out how much money you need to retire. Let's say that number is $70,000 a year. So let's say your average yield was around 3%, which isn't crazy high, but isn't crazy low. I would say that's a good dividend to have. If you want to receive $70,000 a year in dividends, you would need $2.3 million at a 3% yield to receive that money. That definitely is a lot of money. You may be saying, I don't have $2.3 million to invest in the stock market and replace my income. Well, I don't either. But the goal is to start early because compounding effect will take place. Time in the market is better than timing the market. You want to let that money grow and reinvest the dividends that you get rather than taking that out. So whenever you get paid a dividend, make sure to be putting that money back into your account and buying more of that dividend stocks. So the dividends that you got paid out has more baby dividends, and just create a whole community of dividends. So I may have left a detail out. That $2.3 million is solely based on dividend income. This does not include appreciation and something called the 4% rule. Well, there's a principle in investing which is called the 4% rule. The 4% rule means that you can take out 4% of your portfolio every single year, and that will continue to grow itself back. So if you had $2.3 million, you would have 3% of that being dividends and then 4% of that being appreciation that you can sell off. This will give you about $160,000 a year in income every single year. So going back to that $70,000 a year of income that you wanted to receive, if you follow the 4% rule along with your dividend yield, you would only need $1 million. Only $1 million, like it's not a lot. But with compound interest and reinvesting your dividends over the year, this is very achievable within 10, 20, 30 years. And it sure is a lot better than $2.3 million. So now that we talked about what dividends are, let's talk about what makes a good dividend stock. A lot of people see these dividend stocks that have 18% yield. So if they put $1 in there, they're going to get 18 cents. And that seems like a great dividend to me. But these things are called dividend traps, and that's exactly what you have to watch out for. A lot of these companies will have high dividend yields like 18, 20, 25% that you want to invest in and say, hey, it only takes me a couple of years to get my investment back. But that's actually a dividend trap because either that's a bad company or they'll end up lowering their dividend once they got you as an investor. I would say good dividend yields are anywhere between 3 and 7%. Anything up in the double digits is going to be very, very sketchy. You have to do your due diligence on this and make sure it's not one of those dividend traps. You also want to take a look at their dividend payout history. This will tell you how long they've paid out that dividend and if they're a growing company, if their dividend has been growing. But some of the companies that you want to look out for are dividend kings and dividend aristocrats. A dividend king is a company that has paid out and grown its dividend for 50 straight years. And then a dividend aristocrat is one that has grown and paid out for 25 years. If you think about this, this is kind of crazy. It's made it through the 2020 pandemic. It's made it through the 2008 financial crisis. They've made it through the 2000.com bubble and so much more. So looking for companies that have 10, 20, 30 years of consecutive payouts, these are very reliable companies. You have Procter & Gamble, who has paid out 66 years. Coca-Cola, who's paid out 61 years straight. You have 3M, who's paid 65 years. A lot of these companies are very reliable in their dividends, and you can count on them for growing them and paying out their dividends every single year. Some aristocrats that have paid out for at least 25 consecutive years are Walmart, IBM, Realty Income, which is a REIT, bit of foreshadowing there, and so many more. If you're a young investor, you want to make sure you're focusing on growth of their dividend. Many companies, like I said, Coca-Cola, have been growing their dividend for 66 years straight or 61 years straight, but this has only been growing by a penny every single year. You know, it is still growth, but it's not the high growth that you want. You want a company that has 7% dividend growth. So if they have a dividend of $1 this year, they're growing it by 7 cents next year. And this is great for young people because you have that compounding effect. The longer you have to grow, the more money you're going to have. One thing I did mention earlier was REITs, or real estate investment trusts. This is basically a company or a portfolio of real estate properties that gains income from these properties and pay out their profits to you, the shareholders. They'll use your money to buy more properties, and in return, you get payouts. The cool thing with REITs is by law, they're required to pay out 90% of their profits back to the investors. So these usually have higher dividend yields. One famous one that I've mentioned earlier was or Realty Income, which I invest in myself. So before I give you a handful of my dividend picks, I have to talk about something important, which is taxation on these. I know it's not the most exciting topic, but everyone should know how their money is getting taxed. Okay, I'll make this short, but with dividends, there's two main sources of taxation. The first one is a qualified dividend, and the second one is a non-qualified dividend. To keep this short, qualified dividends are stocks or companies that are taxed at your long-term capital gains. So this can be anywhere from 0 to 20%. In order for them to be qualified, they have to meet certain IRS standards. On the other hand, non-qualified dividends are dividends that do not meet those IRS standards and are taxed at your normal income. So one way to get around these taxes is investing in your tax advantage accounts like your HSA, your Roth IRA, your 401k. If you invest into these post-tax retirement accounts, you can avoid paying tax on those dividends. And another question that many people have is, if I get paid a dividend but I don't withdraw it from my account and I just reinvest it into the same stock, do I get taxed? Sadly, yes. I hate to say it, but yes, you do. Anytime you get paid a dividend in a normal brokerage account, you will get taxed. So make sure to take advantage of the tax-free accounts. So like I promised you guys, some of the good dividend stocks that I invest in is, like I said, number one, which is Coca-Cola. that has a good dividend around 3%. You have Realty Income, and another one is SCHD, which is an index fund of dividend companies. This is a great one because it's not only one company, it diversifies into many companies, and it also gives you that dividend or that income every single month or quarter. Other companies that I like for dividends are Pepsi, and surprisingly, one tech company that pays dividend is Apple. They pay a dividend about 0.55% right now. It's not the highest, but the good thing with Apple is not only are you getting that cash flow, but you're also getting the appreciation over the year. Apple is one of the most prominent companies in the world. So to wrap it up today, what we went over today was what a dividend is, how these dividends are taxed, what makes a good dividend and what makes a bad dividend, and a few other things. So if you guys enjoyed the video, make sure to like, subscribe to the page, turn on that post notification bell, and we'll see you guys in the next one.